While most traders are analyzing the same price charts and technical indicators, there's a different type of data that comes directly from the US government that shows you exactly what the biggest players in the market are actually doing with their money. And it's not based on opinions or predictions, it's actual position reporting from hedge funds, commercial producers, and institutional traders who are required by law to disclose their positions. I'm talking about COT data, commitments of traders data that is published every week by the CFTC, the Commodity Futures Trading Commission. The reason this data is so valuable is simple. It's not derived from price like most indicators. It's fundamental data that shows you real positioning before big moves happen. My name is Thomas. I'm here from COTBase.com, and I've been analyzing this data for almost 20 years now. I've mentored countless traders to profitability, and the reason I've been able to catch major market moves is because COT data gives you something unique, transparency into what the smart money is actually doing. In this video, I'm going to show you exactly what COT data is, why it's different from every other type of market analysis, and how you can start using it to make more informed trading decisions. The key thing to understand is that while technical indicators tell you what already happened, COT data shows you what's building up in the market before the crowd realizes it. Part 1. What is COT data? COT data is essentially a weekly snapshot of who's holding what positions in the futures markets, and this matters more than you might think. Here's how it works. Any trader holding positions above a certain reporting threshold must disclose their positions to the CFTC. We're talking about the commercials, oil companies, mining companies, agricultural producers who actually deal with these commodities in their business. Then we have the large speculators, hedge funds, investment banks, managed money, and finally, the small speculators. Now here's what makes this data fundamentally different from price-based analysis. Most indicators, RSI, moving averages, MACD, they're all derived from price. They're reactive. They tell you what the market did, not what it's about to do. COT data is different. It's actual positioning data. It shows you how much exposure each group has, and more importantly, how that exposure is changing week by week. Let me give you an example. In crude oil, when we see commercials, the oil companies and refiners building large short positions, they're not speculating. They're hedging their business operations. They have inside knowledge of supply and demand fundamentals that the general public does not have access to. So when you see commercials consistently adding to short positions, while large speculators are getting more bullish, that divergence often signals that a top is forming. The people who know the business best are positioning one way, while the speculative money is going the other direction. This is why COT data is so powerful. It shows you the positioning of informed participants versus speculative participants, and historically, the informed participants have a much better track record. Part 2. The 3 types of traders and their signals. Now, to really understand how to use COT data, you need to understand these 3 groups of traders and the specific signals each group provides. Because each group has different motivations, and when they reach extreme positions, they give us very different type of trading signals. First, we have the commercials, the producers, processors, and major hedgers. These are the most knowledgeable participants because they're actually in the business of these commodities. When commercials reach extreme positions, it's usually because they see something in the fundamentals that the market hasn't recognized yet. Their dynamic repositioning often leads to major market tops and bottoms. Let me show you an example. In the soybean oil market, we saw commercials engage in drastic selling, reaching extreme short positions. This preceded a massive drop in soybean oil prices. The commercials saw the weakness coming before anyone else. Second, we have large speculators, hedge funds, investment funds, and large traders. During trends, large speculators are generally on the right side of the market, but near peaks and bottoms, they tend to become overextended. The key insight is this: COT data nicely supports the old trading maxim. If there are no buyers left, prices cannot increase further and will start to drop. When large speculators reach extreme positions, it often signals market exhaustion. Notice how clearly the green line tracks the major trend. When it's above 0, prices rise, and once it slips below, prices often decline for months. Third, we have small speculators. These are generally the weakest holders of positions, and since their accounts are small, margin calls can come easily and after relatively small price drops. This makes them extremely good contrarian indicators, especially for short trades. Whenever they're in hype mode, they're prone to overposition themselves, and that often marks important turning points. Here's an example in gold. We saw how extreme positioning of small speculators long preceded a 13% decline. Part 3. The advanced signal, commercial capitulation. Now that you understand the three trader groups, let me show you an interesting COT signal. This is something that happens rarely, but when it does, it can lead to some of the most explosive moves you'll ever see in the markets. It's called commercial capitulation, and it occurs when even the smart money gets caught on the wrong side and is forced to reverse their positions. Remember, commercials have deep pockets and an information advantage. Their stress barrier is high, but it's not absolute. Here's how it works. Commercials hedge the most when they believe current prices are very favorable for them to hedge their future production. But sometimes major shifts occur that force them to unwind their hedge positions. As their losses grow to critical levels on their trading accounts, they have to liquidate, buy back short contracts, or sell their longs. But here's where it gets interesting. These trades further fuel the steep price moves that cause the unfavorable situation in the first place. It creates a positive feedback loop that leads to parabolic price rises. Let me show you a perfect example from the cotton market. Commercials had built up extreme short positions, thinking they were hedging at favorable levels. But as cotton prices kept rising, their losses mounted. Eventually, they were forced to buy back their shorts, which pushed prices even higher. The rally got explosive precisely when prices exceeded the levels where commercials had done their extreme hedging. This is commercial capitulation in action. Part 4. How to analyze COT data like a pro. So how do you actually analyze this data to find these signals? Well, there are specific tools and techniques that we use at COT Base to identify these opportunities, and I'm going to show you the most important ones. COT changes, understanding what is happening now. The first tool is COT Change Analysis. This shows you how traders have changed their positions from one report to the next. By measuring recent changes in traders' positions, we can understand if they are expecting a sudden price movement or not. COT change signals are short-term signals where we expect price reactions to happen within days. COT Extremes, finding historical significance. The second tool is COT Extreme Analysis. This shows you how many reports ago were trader net positions at the current level. Sometimes you'll see a result that says all time, and that means there has never been a precedent to the current readings in the entire history of COT data. That's an incredibly strong signal. You're seeing positioning that's literally unprecedented. These all-time extremes often mark major turning points in markets. The COT Index, normalizing historical data. Another way of measuring COT extremes is by using the COT Index. This normalizes COT data on a 0 to 100 scale using a look-back period that you can set. A 100 reading shows that during the look-back period, the current reading is at the maximum. A 0 reading shows that it is at the minimum. This helps you quickly see where current positioning stands relative to recent history without having to calculate percentages yourself. Understanding market-specific behavior. But here's something crucial. Different markets have different characteristics, and you need to understand these nuances. For example, in some agricultural markets like live cattle, the structure is different. Since farms can be relatively small, many farmers who are actually the commercials in the market get classified as non-reportables instead, as they do not reach the reporting limits. They become small speculators. So in these markets, small speculators can actually be the smart money because they represent the producers who know the business. This completely changes how you interpret the signals. Volume and open interest analysis. We also analyze volume and open interest alongside COT data. We use a scoring system with a default 5-day look-back period. The maximum number of points a market can get is 20 for this period, with plus 20 considered very bullish and minus 20 very bearish. From our experience, reading above or below plus 8, 10 are good signals worth paying attention to. When you combine these tools, COT change signals, COT extremes, the COT index, and volume and open interest analysis, you get a complete picture of market positioning that shows you not just what's happening, but how significant it is historically. This is how you separate the noise from the real opportunities. So if you want to learn more about COT analysis, visit cotbase.com, where we provide the most comprehensive COT data analysis in the world, as well as our indicators which are based on COT analysis and smart money movements. Our iCOT intraday indicator with after signal is our most advanced tool, and for the 2-year subscription comes with a 33% discount. Thanks for watching, and I'll see you next time.